Hello, and markets have gone a little bit quiet for a moment, but that certainly won't last very long. And in Australia, unfortunately, and we can't sugarcoat it, I think it's a mistake to do so. In Australia at the moment, the COVID situation is getting worse. It's still far less than anywhere else in the world, except maybe New Zealand. But it is getting worse, and our government's approach to the situation is to try and suppress it. And that will mean ongoing lockdowns. So we can argue about that. I know there's two sides to that argument, but the reality is we have to call it as it is. And as it is, we're going to be in lockdown in New South Wales as cases expand in the Dubbo and Western New South Wales area for a very long time. And there's no easy way out of that. And I think we need to be aware that vaccinations are not a silver bullet, as I've been sort of screaming from the rooftops from the very beginning, and data from around the world supports that point of view. So I think we may be setting ourselves up for a level or a degree of disappointment going forward, and that's very important from the trading and markets point of view, because the Australian market has really tried. I mean, it became the pattern of the price action in Australia that when a lockdown was announced, the stock market rallied. That's how much the Australian fund managers wanted to look past what was going on. So to sort of outsmart the market thinking, well, anyone else would sell, but I'll buy. But they didn't realize that everyone was buying, and therefore the market is very long. And that's why the recent rally has been struggling quite a bit. But coming back to the economy, we have New South Wales in lockdown, Victoria in lockdown. Cases there remain concerning. We've got sort of a bit of a rise in cases in Northern Territory on the day, and the borders being entrenched against New South Wales in particular, but that could become the case with Victoria at any time as well. ACT in lockdown, Southeast Australia. The national economy is almost at a standstill. Exports are ongoing, of course, but China keeps wanting to decrease its demand for our iron ore as well as our other exports. It's encouraging Brazil to come back online in larger quantities so it can buy from Brazil instead of from Australia. So, Australia has peaked in terms of its exports to China, and that is a situation that will probably last a good 10 years. This is not something that's going to be reversed and solved in any quick time kind of process. So I wanted to show you this chart here. And we'll put it up on the screen for you, of course. It's the Australian construction output data, which shows that the economy was really already beginning to roll over and weaken in the second quarter in construction, which had a lot of stimulus built into it. That's not a good sign. And this is before the lockdowns really started to happen. So the Australian economy is structurally was rolling over, getting worrisome before this outbreak. Before the whole COVID situation, the Australian economy was growing at about 2%, nothing spectacular. Even before COVID, we're just struggling, sort of bouncing along. And now we've had all this massive stimulus, probably the highest per capita in the world, and we're already rolling over again. This situation is going to get bad. Now, bad is a very negative word, but the positive is it's better to know of it in advance, be prepared for it, than to be blindsided by some outcome you weren't expecting. So I really do advocate, just be aware the underlying economy could well be in trouble coming out of this lockdown period. Assuming we come out of it, it might be a year away for New South Wales. Hopefully not. Hopefully it's 1, 2 or 3 months away. There's every possibility it could be 3 months or 4 months away. So the economic situation, the fundamental situation is not good for Australia. The price action in equities, well, also I just want to show you in the US, if you think COVID isn't having an impact on the US economy, this is the Richmond Fed Manufacturing Index. It just collapsed in the most recent data released yesterday. That's the impact Delta is already having on the US economy. People who think Delta isn't going to have an impact, really think again. I really do implore you to think again. In terms of the actual market price action, this is the Australian stock market every half hour. I think it can roll over to the downside here quite significantly. It's trying to follow the US market higher. I just don't see it being sustained. The Australian dollar is also looking heavy. And I also wanted to show you my favorite, gold. Gold could correct a little bit here down to sort of 1792 maybe, 1793. But then again, there's a good chance it could hold above 1801 and continue higher. So my outlook for gold is it can go to $2,500. Why? Because Delta is a bigger problem than markets are facing, than markets are pricing, and it's a bigger problem than most people in markets expect it to be. The end result will be that markets will play catch up. But if there is any degree of large scale, even small scale actually, but around the world, global panic towards gold, gold will go a lot higher because there aren't a lot of sellers left in that market, I suggest. We've had some good sell-offs, and anyone who is going to panic sell out of gold has probably already done so. People are short gold because they thought, as I did, that we'd see tapering and interest rate hikes sooner than we probably will now with this Delta impact. I still think we'll see tapering this year. I still think we'll see an interest hike next year by the Fed, but both of those processes will be delayed by a few months. So people were selling gold because they didn't think there was going to be any because they thought they were going to start to see yield return again for the deposits. Now that we're not going to see that, then I think gold is on an appreciation path, and I think it is a hedge against the crisis and well worth a look. In terms of US stocks, again, that same story, not pricing in an economy that was already fragile. I mean, we're talking about an economy that only got back to 2019 levels of activity with 30% of GDP stimulus pumped into it over the last 18 months. That's not a strong, naturally strong economy that will continue at that pace. As stimulus measures sort of begin to diminish, and infrastructure will not replace those stimulus measures by any stretch of the imagination, as stimulus measures start to wear off, the US economy will again begin to slow. And with the Delta crisis surge, it could slow rather quickly. And the Richmond Fed index certainly suggests that is the case already. Thank you very much. Have more for you tomorrow. Clifford Bennett, Chief Economist, ACY Securities.